Hello, everybody. Welcome. And the numbers came out for the GDP, and they are the biggest miss I've seen in recent memory. So we were expecting GDP to be growing over the last quarter at 2%, and it only came in just over 1%, a 50% drop from what we actually were expecting. And this is actually not surprising. This is what I was thinking. I thought their calls were much too aggressive, but let's jump into it and see what they were talking about. So if you go over to CNBC, you're going to see the US GDP rose at 1.1% of the pace in the first quarter, and it shows signs that the economy is slowing. But of course it is. Now, these are the important points of it. Gross domestic product rose at 1.1% annualized pace in the first quarter, well below the 2% expectation. Now, remember, gross domestic product is what they use to measure the size of the economy. What is the total contribution of all the workers and all their productive capacity? What did they make? What did they build? What did they sell? So this is the measure that we're going to be looking at for any healthy economy, no matter what it is. Now, number 2 point was slumping inventories and general decline in private investment. So this isn't just a general decline, it's actually a massive decline. And we're going to be getting to that in a second. Now, inflation was higher than expected for the quarter again. So that's PCE price is rising 4.2%, even though the estimate was 3.7. So that the inflation actually blew it out of the water. So when we combine all of these things, you should have no question in your mind whether or not we're going to be raising the interest rates in the United States again on the next quarter and the next meeting next week. This is going to be massive that they're going to be raising this rate at, like, for sure. How much? Probably 0.25%. And you guys know that that trickles down to every car loan and everything else. Now, here is US real gross domestic product. As you notice on this chart, you guys can see it at CNBC, or you could watch it on our YouTube videos. The first quarter of 2020, obviously the world shut down. We lost 30% of our GDP. I'm surprised it wouldn't have been more. And of course, the next quarter in Q3 of 2020, there was a massive rebound, 35%. But we got to take that out of the picture. Here is the thing, is through all of time, we would normally say that a recession is two quarters of declining GDP. Okay. And so if you look at the chart, you can actually see 2 quarters of GDP going down in 2022 Q1 and 2022 Q2. They were both negative. Okay, so this is the funny business that actually was happening. If you guys have been following me for a while, last year in April and May, you saw me saying we are in a recession, guys. We are already in a recession. There is a decline, and we saw home prices drastically falling. And I said commercial would fall much later. So as we saw it falling, July 1st last year would have been the official declaration of when we're going to start the recession. If you just type into Wikipedia and go to recession, it'll tell you the definitions of a recession, and it will say right there, declines in real gross domestic product for 2 consecutive quarters. 2 consecutive quarters. So that means we would have been in one. Although if you look in the first paragraph, the US did not want to be officially called into a recession, so they tried to change that definition. In the second paragraph, it mentions in the United States, a recession is defined by a significant decline in economic activity spread across the market, lasting more than a few months, normally visible in GDP, real income, employment, industrial production, and sales. A significant decline, and this is where everything went wonky last year, you guys, because they tried to change the definition. Remember, it's just a bunch of economists and Fed officials that get behind a meeting, they close the door, and they have a discussion with themselves and decide whether they're going to declare a recession or not. Normally, it's 2 declining quarters. We had 2 declining quarters. So we were in a recession, but they wanted to say, well, we can't have a recession if we have a lot of employment. Well, if we see in Canada and the United States, they brought in a lot of immigrants that came into the country. Canada, world record. Like, we brought in for GDP enormous amounts of people. We brought in over 1 million and we're a small population. And so now when they all go get a job, it kind of messes up with those job numbers and it makes it look like it's better than it actually is. Let's continue on because I think this is important to dig into. If you look at Canada's GDP overall, Canada's GDP has been hovering just like 1%, 0.7. And in 2022 and 2023, the last two quarters, 0.8, 0.6. So squat. It doesn't take much to fudge the numbers to just get you over 0%. Okay, so if we go to the United States, their GDP has gone up in the past 3 quarters, and then it now is just teetering. It's gone down, down, down. We're going to check that out in a few minutes. So if we want to actually get really, really, really particular on this, I want to share something that I prepared for you because I think inflation is very, very important for us to understand and for us to actually work with. So if you understand the math, I think that it can help us to make better decisions in our future. So just let's imagine I live in Canada, and in Canada, we go to the United States all the time. So in the United States, we know that it takes $1.30 or thereabouts Canadian to buy a US dollar. So in our brain, whenever we look at the price in America, we're adding 30% to that. And we are figuring out if it's a good deal or not, if we should buy it in Canada or the United States. So we have to understand that the price is always changing. The currency units are always fluctuating. So here is an example that I want you to think about. If the GDP totally was worth $1,000 and we had 1,000 currency units, what would that be? Okay. So now it's 1-to-1 and a loaf of bread is $1. Okay. So if a government decides to overnight, for no reason, decide to double the currency supply. So instead of having 1,000 $1 paper bills, they decided to have 2,000 paper bills. What would that do is my question for you guys. What would that do? So if they did that, instantaneously, you would have $2,000 of GDP, 2,000 currency units. Obviously, they changed that. But what would happen to your loaf of bread? Your loaf of bread would absolutely be valued now at $2 instead of $1. So by printing more money, we have devalued the value of each single currency unit. Do you understand what I mean? So if we are measuring the GDP in dollar forms, we should also double that. So when in example 1, we were at $1,000 of GDP, $1,000 of currency, and $1 a loaf of bread, overnight, the king or whoever it is in the area decides I'm going to double the money supply. And now the country would be $2,000 worth of work. We've doubled it. Where I have 2,000 currency units and a loaf of bread is $2. Overnight, we changed the money supply instantaneously, but we did not increase more businesses. We did not increase the supply. But technically, we went from 1,000 currency units for our national economy to 2,000 units for our national economy. My question to you is, that would be a 100% growth, but that is digging into it, right? We would have been 1,000% different. So the question is why would somebody do that? And the answer is very easily, absolutely, we would never do something like that, right? But here is where it gets kind of funky. Say that you used to get paid $10 an hour at your job, and then instantaneously prices double and the currency doubles. Okay. And they give you a 50% raise. I know that you were getting paid $10 an hour just to keep up with inflation. If they doubled the amount of currency that's out there, you would now have to make $20 an hour. But then if they only pay you $15 an hour, then you have a 50% raise, correct? We went from $10 to $15. But in order to keep up with inflation, you would have had to make 20. So even though they'll tell you, hey, you should be happy, you got a 50% raise, but you're like, still, my quality of life is 50% lower because everything went up double in price. And this is why you really, really, really have to understand the measuring stick that we're using in the economy. So the US, just imagine, since COVID started, imagine we were going to say we had 50% more money because of massive money printing. That would mean that we would have 50% more taxes because we have 50% more currency units. That also would mean that the GDP in the country, because it's measured in dollars, should be up 50%. So if we are up 50%, we would not have grown. If the number of currency units grew 50% and the GDP grew 50%, we would not have grown. Same example as we gave you with that loaf of bread. If we're only up 1%, that means we're way, way down. And here's the problem is we are using an imperfect measuring stick. That is the problem, is because imagine you're out on a hot summer day and you have an ice cube. And I've done this example in front of places where I've spoken before. Imagine you take an ice cube and I say to everybody, is this an ice cube? And it's dripping and it's melting. And everyone says yes. And I hold it for a couple more minutes. The heat from my hand is melting it. Is it still an ice cube? People are saying yes, yes. But slowly but surely, as that ice cube is getting smaller and smaller and smaller, less and less and less people agree that it's an ice cube. But all can confirm that eventually nobody will agree it's an ice cube. It just drops off. That is the value of a US dollar over time. It's already lost 97 cents of its value since they created it in 1913 to today. It slowly melted like an ice cube into squat. And so this is why if we're measuring it in US dollars, which is a melting ice cube, we have to dig into it a little bit more to see what is actually happening in the economy. So let's take a little bit of a deep dive because it was such a massive miss today. So if we look at the GDP of the United States, we saw that it actually had dropped 2 quarters before. But if we look last year in Q3 was 3.2%, then 2.6, and then now it's 1.1. Massive miss, but you should be able to see the trend from 3 to 2 to 1 as it's declining. Where do you think it's going to go next? They're fighting with everything they can to keep that number up as high as possible, but there's only so much that you can fudge the numbers. So US GDP, if we actually go and take a look at the charts, if we look from 2020 right to 2023, so from before all the shutdowns till then, it went from 21,000, and we're measuring in billions, right? 21,000 up to 23,000. So what did the GDP actually grow in the past 3 years? It only grew like 10%. But if we look at the amount of currency units that they printed, we could see that it's actually a long ramp, and then it just like went off a trampoline when all the lockdowns happened and went straight up, straight up. Okay, so if we want to measure this a little bit more precisely and say it's only from 2020, well, it went from 16 all the way up to 21. So you got to tell me, what is that, 30, 35%? And therein lies the problem, you guys. So if they have increased the currency supply by 35%, if the GDP would have grown 35%, we would have been equal. But we've only grown 10% and 35. So where did the other 25% go? That's where it goes to consumption, to governments and to payouts and to wherever else. And this is not an American problem. This is Canada, Europe, Australia, Japan. It doesn't matter where you go. This is happening everywhere. And this is the game. And this is why financial education is so important for people to understand. If we look at Canada, you think Canada is any different? Look at our M2 money supply, straight up like a rocket ship. Okay. If we look back, it went from 16 to 24, even worse than the United States, even a higher growth rate. So this is what you have to understand is if you look at this chart, I have 2 charts, and you can see this is till 1971, wages actually kept up with productivity. But in 1971, what happened in 1971 is we went off the gold standard, right? Obviously, there were some oil embargoes, the Arab Spring in the 70s, some other problems. And then 1974, we signed with the United States. So there was a break apart here. And so when there's this break apart, productivity continued to go up, but wages started getting cut. If you remember my example before, that if you were paid $10 an hour and they doubled the money supply, remember I said you only get paid 15 bucks, but you're like, hang on, I should have got 20. And they're like, you should be happy you got some type of an increase of pay. So this is where companies and governments profit from inflation. And so this is the productivity gap. I found another one that you can go to epi.org where it has it up to 2020. And you can also see in the 70s, after that, there's this split apart where the productivity goes right up, but wages stay flat. And this means that workers go farther and farther and farther behind. So I have some friends that work for the government. Now, when they were hired back around 2000, they were able to still buy a 3-bedroom home. They were able to still have their wife stay at home with the kids. They were able to have a cottage and a Camry outside, not like a BMW or nothing. But now a lot of those workers, the same workers, if they're hired today, cannot live within 2 hours of the city that they service. Those big cities over 1 million, because the costs have gone so astronomical on properties that they cannot do that. So though nominally the same number of dollars, maybe they went from making 80,000 a year to 100,000 a year. The difference is though now, Before, you could have bought a fully detached 3-bedroom home, and now you have to bunk up in an apartment with 2 other friends and rent it. And that is the main difference. So this is the danger. Remember that ice cube melting that I was talking about? This is the danger. If you measure everything in dollars, you're not doing your due diligence and making smart investments either. So we're into this real big crunch now, and this huge miss that they were expecting this GDP to be so high is going to give them all the ammunition that they need in order to continue on and make sure that they're going to be raising that rate. I don't think that there's any way out of it. Now, it's talking about personal expenditures is way up 4.2%, and it missed the 3.7 estimate. Of course, they want to say stripping out food and energy, so they call that core inflation, 4.9 as opposed to 4.4. And so if you know anything about the Fed, they keep talking about the fact that they want to base their decision based on core inflation. And so core inflation is even worse than they were expecting. So I don't see any way that they're not going to be raising rates again. This is just crazy to me. But it always drives me crazy that the core inflation says it strips out food and energy. So of course, no human poops, right? No person eats and no person drives a car or takes public transit. Just show me the person doesn't use any fuel or food in their life. I'd be interested to find that alien. Anyway, you guys, so big misses today. Now, they said we thought that we would see more slowing at this point. Wow, that is a big point. Of course, they thought that raising the interest rates as high as they did would have had a lot larger effect. Now, notice gross private domestic investment tumbled 12.5%. If people don't have money to make investments into companies, getting loans to go to school, to open a business, to buy merchandise, to do R&D, to lose 12.5% of investment is massive. So remember that the economy isn't instantaneous. Imagine like the giant ship, like I'm not going to say Titanic, but a big cruise ship. And it's going and it has so much weight and so much inertia, and that little rudder at the back, that's the interest rate. When they change that interest rate, it takes time for that boat to turn, but we're very confident it will. So raising the interest rates to the price that it is today will continue to curb the economy, but it takes time. Milton Friedman said it normally takes 3 years to see the first rate hike effect. In today's world with hyper communication and everything, it can take 18 months, but we're not even close to 18 months from the first rate hike, let alone the last rate hike. So we got a lot more fireworks to see, guys. We're in the second, third inning right now. If we look at that, domestic investment tumbled really badly. I really suggest that you guys take a look at this and do a deep dive into this because it's going to really open your eyes. I think that the number one thing you have to understand is what is money. And I want to challenge you on this point is please go out there and ask your friends, explain to me what is money. Because I was told my entire life that little piece of paper was money, but it's not, it's currency. There's a big difference between money and currency. And so understanding the difference and understanding what the measures are will really help you make better financial decisions in your life. Also, what I would do is in Canada and United States, we're not used to seeing this type of inflation. We're used to seeing inflation pretty stable since the 90s. Obviously, that is because of different things that were happening in the World Trade Organization, China being able to come in at 0% duty for the United States. Russia, the Soviet Union fell. They're dumping an empire worth of raw goods on the market for super low prices. And that kept inflation down for a very long time, for 30 years. But we're not in that. So how can Canada and United States learn how to invest better from inflation? My suggestion is look at countries that actually have huge inflation. I'm talking about the Lebanon and Venezuela and Argentina's, or just pick a country that has very bad inflation. Zimbabwe's in the news a lot in the 2010s and now. Pay attention to what they did to make money in high inflationary environments. If you are prepared and not retroactively reacting, you're going to be way better off. Believe me, this is not a time to be sleeping because I'm super excited about inflation. Some of the best deals of your life can happen when there's inflation. They always say that this big inflation problem, the interest rates that are there, it's like a pig going through a python. Like the python already ate it, and we have to wait for it to work its way through the system. Kind of gross, right? But that's the way it is right now. And so if we keep waiting for this, it will equalize itself. It takes time. There's a lot of commercial real estate, which I think is going to be the canary in the coal mine. We're already seeing a lot of people underwater and in negative amortization polarization in those deals right now. We're seeing some residential real estate down 20, 30, 40%, nothing compared to what we're seeing in commercial real estate. So a lot of the commercial real estate, there's a big bulk of it coming up in 2024. We expect to see this ramping up from now all the way until then. So there's going to be some real interesting deals that are out there, and it's going to be only for those people who have seasoned money already waiting and ready to buy some really good deals once you understand the mechanics of that ice cube that's melting. All right, you guys, thank you so much for coming by. Hope that this helped. Please remember to like and subscribe and follow and tell your friends about us. We'd love to have them on here too. Have a great day, everyone.